So, when you think about finance, stocks get all the attention, right? They're the noisy, flashy waves crashing on the shore. But bonds are the deep, powerful ocean currents that are actually directing the entire global economy. Let's dive into this world, which is, believe me, way more important than most people think.
Take a look at this. It might seem like just a simple IOU, maybe a piece of history. But what it represents, a simple promise to pay back a debt, is the engine of a market so huge it affects your mortgage, your car loan, and yeah, even the fate of entire countries. Today, we're going to show you exactly how.
So, how does a simple promise between two people blow up into a multi-trillion-dollar global market? Well, it all starts by realizing that the bond market, at its very core, is just the world's biggest and most organized system for IOUs.
I mean, it really is that simple. It doesn't matter if it's the government trying to fund a new highway or a huge corporation building a factory. All they're doing is borrowing money from people like you, the investor. And in return, they give you this formal, official promise to pay you back, with a little extra on top for your trouble. That's it. Now, to turn that simple promise into something that can be bought and sold by millions of people all over the world, it needs some standardized parts. It has to be predictable. So let's pop the hood and take a look at the anatomy of what makes an IOU into a tradable bond. Okay, so every single bond out there has these four core pieces. The face value, that's just the original loan amount, what you get back at the very end. The coupon rate, that's the good part. That's the interest you get paid for lending out your cash. Frequency just tells you how often you get that interest payment. And maturity, that's the finish line, the date you get your original loan back. And here's the main appeal, why it's called fixed income. Unlike the stock market, which can be a complete roller coaster, your payments here are set in stone. As long as the issuer doesn't go bankrupt, you know exactly what you're getting and when. It is all about predictability. Of course, not all promises are created equal, right? A treasury bond from the government is like the chieftain's promise. It's pretty much considered the safest asset on earth. But a corporate bond, the boss's chip, well, that's riskier because a company could fail. And because you're taking on more risk, they have to pay you a higher interest rate to make it worth your while.
So, we know what a bond is and who's issuing them. But who are the big players whose actions actually move this massive market? It really just boils down to three main characters.
First up, you have the central bank, like the Federal Reserve in the US. Just think of them as controlling the main water faucet for the entire economy. When they crank that handle to raise interest rates, they make money more expensive for everybody, and that sends huge ripple effects through every single bond out there. Next, you've got the Treasury, the nation's accountant. They are the single biggest borrower on the planet, constantly issuing new bonds to pay for everything. And their number one goal? Get all the money they need at the absolute lowest interest rate possible. And finally, we've got the hounds, the market traders. These are the pros on Wall Street who aren't paid to think about today. Their whole job is to sniff out the future. Their collective bets on whether the economy is going to boom or bust, or what drive bond prices up and down second by second. Okay, now this is where it all comes together. If you only take away one single thing from this entire explainer, make it this. We're talking about the simple, powerful, and absolutely unbreakable rule that governs the entire bond market. Let's put you in the driver's seat for a second. Imagine you own a bond that pays you a steady 3% interest. Life is good. But then the Fed suddenly hikes rates, and all the new bonds being sold now pay 5%. So my question to you is, who on earth would want to buy your old, low-paying bond at its original price? And the answer is, nobody would. This is the great seesaw effect. When interest rates in the market go up, the price of your existing lower-rate bond must go down. It has to. And of course, the opposite is true. If rates go down, your old high-paying bond is suddenly the hottest ticket in town, and its value goes up. And I really need to stress this point. This is not a suggestion or some kind of market theory. It is pure math. The price of that old bond has to fall by a very specific amount so that its total return is competitive with the new bonds. The market forces this to happen. It's a law of finance. Okay, theory's over. Let's apply this iron law to what's happening in the real world right now. Why does any of this matter for the market outlook heading into 2026? Well, because the global economy is currently walking on a very, very fine line. The whole game today starts with this number. After that massive wave of interest rate hikes to fight inflation, we are sitting at a historically high starting point. And what that does is it sets the stage for some really dramatic, potentially huge moves for that great seesaw. So from here, traders are basically placing two huge bets. The first is for a soft landing. That's where inflation cools down and the Fed can start gently cutting interest rates. And what does our seesaw rule tell us? When rates go down, existing bond prices go up. Big time. The other bet is for a hard landing, a recession. That would force the Fed to cut rates even more aggressively, which would cause an even bigger price rally in the safest government bonds.
So you see, both scenarios point to falling rates, but the reason why they fall matters a lot. So as the global economy walks this tightrope between a controlled cooling and a painful recession, that great interest rate seesaw is coiled and ready to make a major move. The only question is, will it ultimately tip towards profit or will it tip towards pain?